welcome to It's No Secret. I'm Christine.
And I'm Kat.
And today on the podcast, we are answering the question of how do I manage rising mortgage rates? Now, we polled our Instagram following a couple weeks ago to just check in and see what our highest financial woe was, or I guess issue that they're having at the moment. Yeah. And this was absolute number one. So we're excited to dig in and get providing some tips and answering hopefully some of your questions that you might have around rising mortgage rates. Now, a little bit of context, mortgage rates have risen from lows of around 2.25% in 2020 to 4.25 today. And the Reserve Bank forecasts that it's going to go up even further to around 5.5%. The one-year fixed term rate is now over 7% for a standard rate and around 6.5% for those with 20% equity.
Yeah.
So that's quite a significant increase. And as a homeowner yourself, Kat, you have been directly impacted by this, haven't you?
I have. Yeah, because our mortgage rates change over in September. So we had the first round of changes, I guess, in last September, where we went from probably, something in the 2s to like something in the 4s. And then, of course, in this September, it's likely to go up yet again. So I don't know. I'll say maybe something in the 6s. I'm feeling optimistic. Hopefully not above that. But also, we don't know how much of a recession we're going into or if we are. So,
yeah, definitely. So, I mean, diving right in, what are some obvious things or maybe not so obvious things that people could do to manage this rise in mortgage rates?
Cool. So, I think this is a really important topic to chat about firstly, mostly because you can't really get around paying a loan off if you have a mortgage. So I guess the starting point is like just acceptance of where we are, right? You know, and trying to not kick yourself about things like, oh, I should have locked in a like longer fixed rate or, you know, seen this coming, because so many people didn't see this coming, in the sense that it is not uncommon that, of course, interest rates can rise, but the speed in which they have risen has been very, very unusual for this sort of time frame. So firstly, don't kick yourself in the behind for that. It's, you know, it is what it is. You may have seen in some of the media the chat around, there's a few articles been popping up about, you know, people being like, oh, my mortgage rates are increasing on a dollar basis by about, you know, $2,000 a month. Where am I going to find this money from? And so I think for potentially a lot of people that are affected by this, we're not talking about small amounts of money. Like it is a relatively large net dollar increase that people are facing. And I think I remember we talked about this on the show back when it was increasing last year, because I think I remember saying to you like, oh my God, our mortgage rates are going up something like,
it was like $16,000 a year or something like that.
Yeah. It was a reasonable amount of money, like enough that I guess we were in a lucky position where we had a cash flow surplus at that point in time. But I was like, if we didn't have a cash flow surplus, like how am I going to find $16,000 of savings over the course of the next year, like in terms of reducing my expenses? Because, you know, as you'll be aware, the only two options with this sort of thing is maybe increase your income, decrease your expenses, or figure something else out to make your mortgage repayments less.
Which, they're not easy either. Those first two, increase your income or decrease your expenses.
No, because as much as I'd love to go to Westpac and be like, hi, could you please reduce my mortgage rate? They're obviously not going to do that. So, yes. And I mean, you are the queen of trying to figure out ways to increase your income. So do you have anything just on that point before we dive into, I guess, other related things? Anything on that you wanted to add as a starting point?
Well, when thinking about this episode, I actually kind of kept that one to very last because I appreciate that there is a lot of uncertainty or what feels like uncertainty in the market right now. But also with, you know, a recent change in leadership, a lot of people are also questioning, you know, their job security if they do work for the government and how that might impact them. And so I don't want to be flippant and assuming that it's easy to increase
for everyone to
your
just go earn more money.
Yeah, exactly. And chopping and changing jobs, yes, it can work in your favor, but it also, you know, for some potential future employers can also not work in your favor. So, you know, and if you listen back a few episodes, you'll hear what we think about passive income and side hustles. So,
Yes.
Yeah, there's always a trade-off. But I think there are some other levers that you can pull as well, if that's not an option for you, which we'll get into now.
In a bit more detail. Yeah. So yes, the starting point is, then if you can't, or you have increased your income and you're still finding yourself in a cash flow shortfall or a really tight cash flow position based on your higher mortgage repayments, most likely, I'm guessing in this discussion, your home loan or a home loan, then you need to look at reducing your expenditure. And as we've talked a lot about before, there are some things that are just actually really hard to cut out because we all have basic needs that we need to cover, right? Like food, transport, roof over our heads, which is our mortgage, potentially childcare if we have families, all that sort of thing. And so it can be quite difficult to reduce your essential spending. So the starting point would be always looking at removing or reducing non-essential spending. This might sound a little bit hypocritical from us because we're also very much like
balance.
Balance is key, and things that make you happy are definitely worthwhile spending money on. However, this might just be a short-term change, right? So, I think of us a slightly different scenario, but example, when Luke lost his job and we were down to one income, we knew that was something that we really needed to do in terms of drastically reducing all of our non-essential spending, but it was going to be a sacrifice for a period of time. Now, whilst we don't know what's going to happen with interest rates and no one can actually predict that, there is likelihood that at some point they will start to come down. We're hoping that they're not going to continue to just go up and up and up. And so you could approach it with the idea that it's a shorter term sacrifice. So, maybe wrapping your head around this is something that we're going to do for the next 1 year, 2 years, 3 years, but it doesn't necessarily mean that you can never go out for dinner again or, your weekends away and never on the cards. It just means that you might need to rein some of those things in for the next wee while. Practical tip, the easiest way to do this, I actually was just doing this myself, is scrolling through your internet banking transactions. It can be really eye-opening. I literally was doing this morning because I needed to. Yes, quick side note, but we need to top up our emergency savings account, and I was like, where is all our money going at the moment? Because I just feel like we're getting paid and a lot of it's going out. And there were things like we had inadvertently, Luke's gym membership had ticked over even though it was meant to be on pause. So we've paid 9 fortnights of his gym membership when I thought we weren't. So, things like that. Didn't notice that was happening. Insurance payments, like just making sure that what you're paying for your car or home or property insurance, also very timely given the current situation with the floods in Auckland, making sure that that's appropriate cover, but also potentially, an area where you could look to reduce costs. Things like power, making sure that you're on, a relevant phone bill. Our phone bill has been outrageous for the last few months, also because we went overseas. But just those little things, I know. I'm like, I think sometimes it's very easy to just put your head in the sand and let those things pass you by until you actually force yourself to kind of scroll through some internet banking transactions.
Yeah. For me and Ollie, what we've been doing, or what I've been trying to be conscious of, is when I say luxury food items, what do I mean by that? So outside of, eating out and things like that, it obviously really does depend on how much of a pressure you're feeling from the rising mortgage rates as to how much you kind of cut those out. But things like not buying the gourmet pesto and just getting the average one, or, maybe it's cutting out all of those kind of frill things and getting really basic with your food items to then cut costs, like salmon.
Luke and I decided to do Feb Fast for health and also budget reasons.
What is that?
Like not drinking in the whole of February.
Yeah, nice.
Because we were like, well, we've just come off silly season and it probably would be good for our health, but then also like realistically good for the hip pocket if we're just buying a few less bottles of wine and beers, and then also taking those things when we go to see friends and all that kind of stuff. So absolutely agree with you on some of the luxury food items.
I do have one more tip.
Yeah.
Just because I was talking about it this morning. If you have health insurance, make sure you're actually capitalizing on it. So yes. Going to things like, if you do have back issues or whatever, going to chiropractors, osteos, and making sure that you know the intricacies of your policies
so you can claim.
Yeah, because you can actually also kind of back credit it depending on how far back you're going to, like, it could be like a mini top up of money in the short term.
Love that. Great tip.
Thanks.
Excellent. So I guess that's on the reduction of spending. There's not really that many tips out there outside of that, unfortunately, in terms of, increasing income and reduction of spending. And so the next stuff that we're going to talk about is kind of ways that you could potentially engage with your bank or think about restructuring your mortgage so that you can free up your position a little bit for a short-term focus. Now, there will be some caveats on this because, of course, any changes that you make in this sense may mean that over the course of your loan, it either takes you longer to repay it, you potentially pay a little bit more over the longer term in interest, but some of these things are potential fixes for the short term that will ease up your situation. So don't necessarily look at them and think like, oh God, but that means that in the next 20 years, this might happen. You might just be using this approach for like 2 years or 3 years. And sometimes needs must. Got to go do what you got to do, people.
Exactly. What's the opportunity cost? You can't pay your mortgage at all.
Exactly. So one that we talked about probably on the show before, but just I guess to re-highlight on, is looking at extending your mortgage term. So Christine, do you know what this is?
Yes, the amount of time. Yeah, as a non-homeowner.
Yes.
The amount of time it takes to pay off your mortgage, and that includes principal.
Yes.
As well as interest.
Yes. So when you get a loan from a bank, they'll offer you a mortgage term. Excuse me. It's usually pretty standard, like 25 or 30 years. Some people do adjust their mortgage term if they say have a certain amount that they want to repay on a particular basis and they want to have their mortgage paid off in a certain time. So you could be like, I want 15 years. But basically all it means is that based on the interest rate and the term, they'll calculate what not only your interest portion is, but the amount of principal that you're paying off in every repayment amount. So as you would expect, if you have a mortgage term that is longer, i.e. 30 years over 25 years, you're paying interest to the bank for an extra 5 years. Therefore, you're paying more overall in interest. Now, who is this more helpful for? People that potentially have had a mortgage for a slightly longer period of time, because let's say you start the day you get your mortgage, it's on 30 years, and then you've owned your home and been paying off that mortgage for 6 years. Your current term, which you'll be able to find out, is only 24 years. Now, you could go back to the bank and say, hey, could we extend that term so that our total repayment is either reduced from what it currently is, or is if you're worried about your interest rate rising from where it is now, you may be able to dampen the effect of that by increasing the term.
Right.
It does mean that you're taking longer to repay your mortgage if you don't then change that back at some point in time. And it does have a somewhat material effect, as we said, if you end up doing that over, the full term. But I would also argue that for a lot of people in kind of our target audience and like listeners out there, your property that you're currently repaying, you're probably going to sell before you hit the 25-year mark anyway. So maybe, in my personal opinion, like if you're stressing over that versus stressing paying your mortgage right now, you're going to do the things to make it easier to pay your mortgage right now.
Yeah. I was also reading somewhere about people who are at that kind of 50 to 60 age bracket, so the circumstance would
be a bit different. Yeah. So, I mean, that is definitely of consideration if you are older, if you're talking to family members that are struggling with this and they're a bit older. The bank does want to be looking at things like, is the term realistic for this person's age? And if they're looking for a term that's longer than, say, good example is, longer than what their potential working career is, what's the exit plan there? So I know in our family, when we had some family members that were getting closer to retirement, basically renegotiating a mortgage a couple of years ago, the bank would look at them and be like, well, these people are in their 60s. We're not going to give them a loan that's 30-year term because they're going to be paying that into their 90s. How is that going to work? They're not going to be working when they're in their 80s and 90s. And that is true. So then you go down the path of discussion around, well, what is the realistic exit plan to either, sell that property at some point in the future and repay any remaining debt, or have that debt repaid by the time that they reach retirement. Yep. So banks are reasonable about those things, but it's something to consider in that you can't just necessarily go to them and be like, give me a 30-year term and not have a prepared answer for those types of questions. Yeah,
definitely. What about, this is tangent, but reverse mortgages? Is that something that people could, I guess that is part of the exit strategy
plan.
That is,
that would be more of an exit strategy type thing. Yeah.
Fair enough. Okay. Yeah. What else can people do?
Well, I guess whilst we're on rates, it's looking at things like fixed versus floating. I guess, the trend in New Zealand is that you definitely have a fixed rate, and that's kind of the vast majority. Some people have always looked at having splits. So, doing the things like having fixed rates on various terms so that their whole mortgage is not coming up for renewal at the same time. And that is certainly a strategy that is valid in a rising interest rate environment, right? Because you might be able to lock in a rate, let's say now, with part of your mortgage being on 1 year, part of your mortgage being on 2 or 3 years, if you're nervous about what potential rises look like. And it just means that then in 1 year's time, that portion that potentially is subject to a higher interest rate at that point is only, a smaller portion of your mortgage rather than it being your whole mortgage. Now, the natural downside to that is if there are rate decreases, it takes you longer for the other parts to come, I guess, and get the benefit of that.
Yep.
But it's all about risk management. What's your comfort level?
Yeah, cool. And just to clarify, a floating mortgage rate is one that fluctuates in line with the OCR.
The OCR, exactly, cool. Exactly. So typically, floating rates will be impacted relatively soon after changes in OCR come through.
Yeah, cool.
So yeah,
nice.
What and they're quite high at the moment. Just going out of frame for a minute, getting my internet banking app so I can reference point this for you.
That's a perfect segue to ask.
Yeah, because I was like, what is my floating rate mortgage? I think it's actually very high, which is terrifying, but I don't ever want to think about it. I mean, granted, we also do use it as our offset account, so we have some money offsetting that balance. But real life example, I do need to go and fix this portion now, because for a time we had we had a large portion that was on floating because we had a large amount of cash sitting to offset that floating portion whilst we did our renovations. Yeah, right. Obviously, as we've done our renovations and that amount of money in that account has reduced over time as we've paid bills, that's kind of changed. Once it got to about halfway through, so I think, let's say for argument's sake, that total amount started at like 100,000. When it got to about 50,000, we split off 50,000 of it as a fixed loan, because then of course we didn't have any more to offset that portion, so we split that off as a fixed amount and locked it in, and then that was kind of towards the end of last year, and then since then we had our holiday savings and stuff offsetting the other amount, but of course we've gone on holiday, we've spent all our money and now we're at the portion of we probably need to do that again, because the floating rate on that, do you want to guess?
I reckon it's around like 3 something.
What do you mean?
Wait, no, sorry.
No, floating rate.
Oh, my bad.
Percentage.
4.5%? I don't know. I don't
have a mortgage. Oh my gosh.
7. What the heck?
7.39%.
Oh my gosh. That's
versus
so
our
much money.
fixed. And granted, this is the fixed of last year, so it's going to be higher when we do this in September. But our current fixed rate is 4.95.
Yikes.
Yeah.
Oh my gosh, I'm so behind the times with the mortgage rates.
Yeah. So, that's a fun time.
Yikes.
Yeah. So it's probably, the also prompt to think about there is if, like me, you have had a floating rate portion for a reason, i.e. you've been, having money in there for potentially renovations, emergency fund, money that's offset that, maybe check base with that and see if that's actually still relevant for you where you're at, because if it's not, you could definitely be incurring some savings by fixing that portion, because even though I'm not going to get 4.95 or whatever it was for my fixed rate now, I'm going to get a better deal than my 7.39 floating rate.
I'm still in shock / slightly embarrassed that I didn't know that.
It's pretty high, hey?
Yeah, and I literally just read out the stat before.
I know, that's great.
What I was going to say is, because you have your mortgage with one bank, right?
Yes.
What does, splitting it up, can you split it up between banks?
Multiple banks? No, not for one property.
No, okay.
No, it's typically because banks don't like to have multiple security partners over the asset.
Right, okay.
Yeah.
So just total.
Yeah, exactly. So you hear about people do have split banks when it comes to maybe owning more than one property. Like they don't necessarily want to have all of their debts with one bank, particularly if they've got their primary residence and then a investment property. That's super common. But definitely, if you're talking about your primary residence, much easier to have it with your main bank. And as we've kind of talked about before, like people don't have a lot of allegiance to that bank based on the bank anymore. It's more around like getting
rate,
exactly, getting the best rate or the best structure. So like shout out to Westpac, do love them, because on the app it's really easy to like see because we've done that and we have, I guess, our debt split into different amounts for different reasons. It's really easy for us to kind of see all the different, I haven't really explained that very well. But all that, like we've got like our primary home loan, and then we've had like a top up to our loan when we did our first round of renovations. That's split out separately. Then we've got another small mortgage that's secured against our property that's for the purpose of investing in a business. That's noted separately. Then this floating portion with our offset account is also noted separately. And I really like that because it's like super clear for me. I can kind of track how it's gone over time. It's very easy to set up like multiple accounts that then can be attached as offset accounts to a floating. So
I guess it makes it also easy to compare what the return or interest rate is relative to the return of what you've leveraged to then go buy.
For sure.
Or invest
exactly.
in other.
Yeah, exactly. So that is a good one.
Nice.
Which perfectly leads us into paying on interest only. Yes. Now, this, I guess, is another strategy that you can consider. I don't know how open to banks are about this at the moment, but to be honest, like as much as we paint banks in the bad light, they ultimately want you to stay in your home. They're not trying to kick people out. They don't want to be doing mortgagee sales. That's a really big pain for you as a customer, really big headache for them. Like it's a lose-lose situation, really. So talking to your bank or a broker about your options is definitely the way to go. And a thing to think about is, yes, paying off interest only. So what we were talking about before is, you have your repayments, which are made up of interest repayments and your principal repayments. Can you shift for a time to paying only interest, which will therefore immediately reduce the amount of cash flow out from your back pocket?
What about for investment properties?
Yeah, I think the same strategy would apply. Yep. The only caveat, I guess, to this, and it would depend on bank to bank, is banks don't necessarily allow you to just do that forever and a day. There might be a fixed period that they allow that. So they might say, yep, we'll enable you to be on interest only for 2 years or 3 years, and then we'll have to reassess. But again, back to the start of this convo, that might be completely relevant and fine based on this being a short-term strategy for you.
Cool. Nice.
Yep. Love it. Ooh, renting out the property. I was like, this kind of falls out under maybe increasing your income, which I was thinking about yesterday, is like, if you, based on time, resource, whatever it is, don't have the ability to actually earn more income, do you have the ability to force your house to earn you income?
Or change how you manage it. Yeah.
And what could that look like, right? Like, are you open to getting a boarder? Do you have a room that could be rented out? Do you have the ability, I know we've also just had a terrible summer and holiday season is kind of wrapping up, but do you have the ability to make, maybe put your home on Airbnb for a time?
For a weekend or something.
Yeah, exactly. For those types of things. Getting a little bit creative with that, being open to, different ways of living in order to get someone else to help you pay your mortgage.
Yeah, definitely. And, you might even save a significant amount moving out, right? So
can you live with family for a short term if it's getting really bad and,
that's a good point.
Rent the house out in whole for, say, 12 months?
Or delay renovations that you'd plan to do or something along those lines,
Yeah. All options are on the table.
Yes.
Love that. Cool. So, Christine, what about if it gets really bad or really hard?
Yeah.
What are my options then?
Great question. So we've kind of listed out roughly 4.
Yeah.
The first one is contact your bank to ask for help. So, and that is way before you start missing payments. So if you can really start to feel the pressure, just communicate. And there is the misconception not misconception, there's the perception that banks are kind of out to get you in some way and that they don't have your best interest at heart. And so I would encourage you to try to look past that and, try to just ask for help with the intention that they are
Absolutely. Well, thinking back to the FSC conference that we went to last year and having people from all of the major banks speak that work in, I guess, the hardship teams and the kind of well-being, customer well-being teams, they had an amazing amount of insights that I was very surprised at in terms of the types of projects and, help that they're willing to give out to people. I think you're right, though. It's you want to preempt that with them rather than be on their radar when you're kind of getting to the tail end. Yeah, exactly. Yep. You don't want to come in through their disaster recovery team. You want to kind of come to them in a positive, forward thinking way and see what solutions that they can work with you on.
Yeah, definitely. And even, there are a lot of community organizations and financial mentors that are offered through different avenues. Google
exactly.
them,
Christians Against Poverty, various different groups that have like free budgeting services to help you, I think, with some of the starting points before you potentially make changes. If things like budgeting are not great or you're finding it really hard, like absolutely reaching out to some of those services.
Yeah, definitely.
In advance. Nice.
The next one, as you kind of already alluded to, is friends and family. So probably more family than friends, to be honest. But if you are in a position where you can move home or move in with family to save, you and possibly them also money if you're renting out a room of theirs or something like that, to then free up your property to then generate income, then that's definitely worth exploring.
For sure.
Yeah.
Love that. You do have your financial hardship with KiwiSaver, and that is, of course, a option for people. I would say that's probably one of the last options because usually to get to the point of having a successful hardship withdrawal from a KiwiSaver, you need to prove that you've gone through a number of other genuine attempts to resolve the problem first. Also, I guess noting that it's not necessarily a long-term fix. What is the actual outcome that's going to happen there? You might be granted a lump sum amount of money, and that lump sum then will cover your mortgage payments for a year. But after that year, then what happens? So just thinking about is that necessarily your first port of call? Probably not. Try a few things first. But if you are in an absolute situation where you just feel like that's your only option, then chatting to your KiwiSaver provider about that as well. Yeah,
definitely. And the last, very, very last option is that weigh up the pros and cons of, reinvesting, as we said, versus owning property. So you might get to a point where you do need to consider what your exit strategy is, or selling out of that home in, place of not putting yourself in a way worse financial position now and potentially in the future.
Yeah. So basically removing the debt from the equation altogether by selling the asset, clearing the debt, and maybe sitting on some money for a period of time, or downsizing, or looking at other options in that way. Yeah. Nice. This sounds like just a really grim end.
Yeah.
There's nothing positive to end on here. Friends, I'm sorry.
One key takeaway, let's do that. We've got one rounding out thought is don't put off taking action or avoid making decisions. So don't put your head in the sand and wait until that very last minute where, you do risk maybe losing your home or are at that point. So
if this is stressing you out now, in the sense that you are potentially like me and your home loan is not rolling over to a certain period of time, but you know that there is going to be an increase in your rates, whilst they don't know necessarily what the increase will be come, say, September, you can work with a broker to give you some estimates, or, jumping on an online calculator even to start seeing what that type of increase will mean in dollars and cents for your cash flow. And the other thing to think about is you could do the trial of seeing if you can actually repay that amount now, right? So let's say, for argument's sake, your mortgage is going from $1,500 a fortnight to $2,200 a fortnight based on an increase in interest rates. Could you start putting away the $2,200 a fortnight from now? And almost, I guess, test out how you're going to go with that change in cash flow before it actually happens. Therefore, by the time you get to the point of it actually happening, you know if there's going to be a problem.
Or how long.
And you've had a bit of time, exactly, to actually see if you need to make genuine reductions in other areas.
That is great tip.
Hot tip. I should probably do that myself.
Take your own advice.
Check back in next week, guys.
Let's see if this happened.
Exactly. Cool. Well, sorry to have a doom and gloom Tuesday chat. Hopefully there's a little bit of positive coming soon. I would say the positive is that, interest rates aren't going to be high forever. Don't quote me on that. Don't hold me to a date. But, there is a positive coming. And I think the other thing is, when push comes to shove, humans are very, very good at finding a way out of a problem. It's inherently in our nature. So just making sure you give yourself time to do that. We have faith in you guys. And if you want to find out more, you can hit us up on Instagram at It's No Secret NZ, or on our website, itsnosecret.co.nz.
Until then, we will see you later. See you next Tuesday.
See you next Tuesday. Bye.
Bye.